In this video, we're going to complete our discussions that we've had in some other videos by talking about how we measure risk when we think of investing, when we think of investing in corporate projects. And of course, we have to always apply a risk return analysis when we're doing any type of investing and financial decision making. So the question that has come is that we have a measure of risk called standard deviation that measures the total risk of an asset, but that total risk has two parts, a diversifiable part and a non-diversifiable part. We have discussed how the non-diversifiable part is really the only part that is important, because in a well-diversified portfolio, that's the only risk that's left. So how then do we measure the risk of an asset that is in a portfolio? Standard deviation, again, measures volatility. It measures the total risk. We have a statistic called beta. And beta is a measure of this systematic, non-diversifiable risk. As you can see here, we have beta, the formula. It's the covariance of an asset and the marketplace divided by the variance of the marketplace. Now, this is very similar to the correlation formula, if you'd see the correlation formula. But this number can be positive or negative, since covariance can be positive or negative, and it can be as very big or as very little as possible. So covariance is a measure, again, of how two things seem to act alike, but it's not truly a very good comparison, since the numbers are relative. Right? They change based on overall the relationship to the variance of the marketplace. So let's continue on next. So the expected percent change in excess return of a security for a 1% change in the excess return of the market portfolio. This is really what beta is measuring. How does the security change relative to the market change? So as we said again, beta differs from measuring volatility. Remember, that's standard deviation. Beta is a measure of systematic risk. So let's see some examples about how this looks, right? So here are some companies. Again, we're not going to spend a lot of time looking at these, but you go down the list, you see here are the companies, their tickers. We can see different industries. And here is what we're referring to as the beta of these companies. So you can see here Coca-Cola is 0.73. Tyson Foods, 0.19. What does this mean? The bigger the number, the greater the systematic risk. Coors, 0.78. Microsoft, Alphabet, Kroger, Netflix, all of these are getting very close to 1.0. And we also have stocks go even higher, right? A little bit greater than 1.0. Disney's 1.29. Apple 1.24, right? Then we can actually We can actually get some pretty high numbers. Chesapeake Energy 1.85, Hewlett Packard 1.77, General Motors 1.64, right? So as you can see, these numbers obviously vary, right? The higher the number, the greater the risk. So how can we interpret this? So let's kind of come back and think a little bit about the stock market. How does the stock market change relative to the stock market? And hopefully it's a silly question, but obviously it changes even up, right? 1% for 1%. So the stock market has a beta of 1. So here's where we're kind of coming back to some earlier topics, right? We said when we were talking about the capital market line and it identified this specific portfolio, the market portfolio, again, we're looking at that one great big sector. But how do we narrow down from the big sector to the individual stock? And that's what this process has done, has moved us down to this point. So the stock market has a beta of 1. Anything less than 1 means it is less average risk than the stock market. Greater than 1 means it's more risky. So again, let's keep kind of reinventing and discussing this over and over again, right? A beta is related to how sensitive it is to general economic conditions. How sensitive is it to the stock market and changes? In cyclical industries, these are very sensitive to systematic risk, and they're going to have higher betas. There are stocks that are not very sensitive, right? In fact, we sometimes refer to them as defensive stocks because they move almost in unison or very closely in unison with the stock market itself. So back again, the beta equal to 1 means it has average risk, less than 1, less than average risk, greater than 1, above average risk. But we can kind of add a little bit of a twist to that and say, look, this company here, Amazon, has a beta of 1.62. What that's telling us is the beta of the market is 1. So Amazon is 62% more sensitive than the stock market is. So if the stock market moves, we would expect Amazon to move much more, 62% more. Go back to the original one. We have here Tyson Foods is 19.19, which means it is only 19% as risky as the stock market. So if the stock market moves by 10%, Tyson Foods is only going to move 1.9%, right? It's 19% as risky, not more risky, as risky. So again, we have this connection now between the riskiness of assets, the excess returns of assets, and the actual risk of those assets. So we've now been able to identify a characteristic that is directly tied to the rate of return of an asset. Since it's directly tied to the rate of return through mathematics, it's also directly tied to the price of the asset. So how can we calculate beta, or how is it calculated? We have a formula. We'll see the formula again here in a second. But beta is a characteristic line. It is, if you look at these dots represent security returns and market returns, actually excess return to be exactly correct. This characteristic line, the slope here, is beta. And as you see in our formula, the rate of return of an asset has an alpha, right? It crosses the vertical line here, plus it has a relationship to this return in the market, beta, right? Beta is the slope, right? But also here we have this E. Remember we talked in a previous video, we talked about some surprises. Well, as you notice, it doesn't show up. The dots don't line up right on this characteristic line. There are some surprises that happen every time, right? So again, if you kind of get rid of this plus E here, we have the same kind of thing we had before. We had the return on an asset is the expected return of the asset, alpha plus beta times the return on the market, plus this surprise. Again, we can calculate, we can use a formula for beta. If you take the correlation multiplied by the standard deviation of the stock and divide that by the standard deviation of the market, again, we can end up with the beta. Again, these are just algebraically equivalent formulas here, but it isn't all that difficult in the end to calculate the beta of a stock. So now how can we ultimately use this? Again, we've been kind of leading into this issue, right, so far. So if you think about the return on the stock market, that's the risk-free rate of return plus a market risk premium. So this market risk premium, if you remember how we calculate that, it's just the return on the market minus the risk-free asset. So how would you find the expected return then of an individual security? It's the risk-free return plus the market risk premium, but now we can identify something inside this sector, right? Remember, the return on the market is kind of like a group. How do we identify an individual in that group? Well, that individual has a beta. So when you multiply beta for the individual asset times the market risk premium, this gives us the riskiness, the asset riskiness of that particular asset, right? So again, this really applies directly to individual securities, but they have to be held in well-diversified portfolios to fully get the benefit, if you will, of the return. So this formula comes from the capital asset pricing model, and technically the formula is not called the capital asset pricing model. The formula is called the security market line formula. Again, just to kind of look, it's the return of the security is the risk-free rate plus the risk of the asset, and the risk of the asset is beta times the market risk premium. So what would happen if beta equaled 0? Then the asset would be a risk-free asset. What would happen if beta equaled 1? Then beta equal 1, we have risk-free plus the return on the market minus the risk-free. If beta equals 1, the return on the asset would be the same as the return on the market. What would happen if beta was greater than 1? What if it was 2.0? And again, the market risk premium component would be twice as big as what it was for the marketplace. So the rate of return would be the risk-free rate plus 2 times this market risk premium. So again, the size of the beta now is what drives the return of the asset. So again, just to kind of finish this and bring things to a little bit of a conclusion, right? This is the security market lines derived from the capital asset pricing model. We use this in a variety of ways for valuing stock. We also use it in the process of estimating the cost of capital. What does it cost the company to go out and gather information or to gather funds from the public, especially in the form of stocks? So in this case, there is in several worksheets, you will find this little place where you can calculate the expected return on a stock. So if the risk-free rate was 2.95, if the average rate of return on the stock market is 10, portfolio beta is 2.99, that means that the expected rate of return for this particular asset is 24.03. As a quick guide, you might try to do this for your company, right? So how would we do this? Well, we need to have a number for the risk-free rate of return. Where would you go to find that number? So I'm going to stumble through this and if we scroll down, if we log in here, we don't need to log in, but we need to go to the investor site. So if you go to the investors, for investors, now we want to scroll down. Again, I agree, it's not always the most easiest place to find information. You can see there is an awful lot of information here. This is the self-regulating site. So we want to go to the Market Data Center. Here's market data. Sometimes if we just scroll down, we can find what we're looking for, which is right here. Here are the Treasury Benchmarks. So on this day, right, a 30-year Treasury bond, so I make that wheel a little bigger, a 30-year Treasury bond is yielding about 1.37%. So that is the risk-free rate for investing for 30 years. Now, typically, for the risk-free rate, since we're talking about stocks, we're usually going to want to use a 20 or a 30-year rate. So the 30-year works fine here. It's 1.37. And again, if you notice, a year ago, rates were much higher, right? They were almost double last year. So interest rates right now are extremely low on the risk-free side. So again, you can go to FINRA, you can find that. We would use the number 1.37 as the risk-free rate. Of course, you know how to find the beta for a company. You just look it up on Zacks or Yahoo Finance, etc. But what number would you use for the average rate of return for the market? We've had several videos on this. I would think 12% is a little on the high side for an average stock in the average stock market. Maybe 10% is the better version. So again, if we could change these numbers, we could just change that would tell us what the return was, or what you expected the return to be for your particular investment. So again, there's lots of ways to find this. What we've now completed with this chapter is a brief explanation. By no means have we really even gotten much more than our big toe in the water here of how we approach risk on the corporate side of things, right? We really don't want to think about individual assets as much as we want to think about individual assets in the context of being in a portfolio. So beta is our magic mushroom, if you will, that's going to help us to understand the riskiness that we see when we're making financial decisions. So hopefully this video was helpful. I'll see you the next time.